All right, well, I'm hoping that some of you can hear me now. Let me know if you can hear. I just heard it. All right. Hopefully folks can hear me now. I understand that there was no audio. Okay. So, one of the most important uses of options is as a hedging tool. Are options too expensive as a form of insurance? When should one use options to hedge? What strikes should one choose? We're going to talk about it and take your questions right now on Open Interest. Hi, I'm Mike Coe, and welcome to Open Mic, sponsored by OptionPlay, where we talk markets, investing, and option strategy, and time permitting, hopefully take some of your questions. I apologize for those of you who were watching before and couldn't hear me, but thank you for leaving it in the chat, because otherwise I would have been just talking to myself for 15 minutes or so. If you're watching this live right now on YouTube, feel free to drop questions into the chat. And just an important note about that, the live chat is only visible on YouTube while the live stream is in fact live. It won't be available on replays. And also, if you're watching this currently on X, formerly known as Twitter, welcome, but I apologize because we don't have a mechanism to interact with posts there in real time at the moment. So you may want to switch over to YouTube/Open Interest and leave your comments there. Today I'm going to cover some of the things I like to look at when I'm considering whether or not to hedge a single stock position going into earnings, and how broader macroeconomic forces, industry analysis, price action, and options pricing influence my decision. Okay, so it's understood that stocks tend to be more volatile when they report earnings. Earnings reports provide crucial information that can significantly affect the valuation and perception of a company, and how a stock responds to earnings also provides clues to investor sentiment. When good companies that have been performing well sell off on good news, that can be a sign that the momentum in the name, the group, or even the market may, at least in the near term, be slowing. And by contrast, when companies whose operating performance and stock prices have been flagging, when they manage to catch a bid, even after reporting, let's say, less than stellar numbers, it's possible that they may be bottoming. And sometimes it's not the trailing results that cause a stock to move. It may be the forward guidance and future outlook that many companies provide. Upward revisions in guidance can lead to positive reactions, while downward revisions can have the opposite effect. So with that in mind, let's consider Lowe's, which is scheduled to report earnings tomorrow morning. Home Depot reported earnings a week ago, $2.82 in EPS, a 14.5% decline year over year from the $3.30 in EPS that company reported a year earlier. Revenues fell by more than $1 billion for the quarter versus the prior year, and over $4.7 billion for the year. That's a 3% year-over-year decline. And this despite the fact that nominal GDP grew by more than 5% over that same period. It's not difficult to figure out why the home improvement retailing space isn't keeping pace with the economy more broadly. Higher mortgage rates mean lower existing home sales. Higher rates make a home less affordable for owners who might otherwise have considered a move, so some homeowners become trapped in their homes if their existing mortgage is at a favorable rate. Right now, I think many homeowners enjoy interest rates below 4% on their existing mortgages, whereas the rate offered on a new 30-year fixed mortgage is closer to 7.3. Moving houses becomes far less appealing if it also means moving from a historically low rate to that higher one. A lot of home improvement projects stem from fixing up a home for sale or improving one that was recently purchased. In fact, existing home sales, and I think we have a chart of this, have fallen to levels that haven't been seen since during the great financial crisis. There's also been a really significant pull forward in home improvement projects. So even ignoring those related to home sales, many homeowners who never had an intent to move were forced to stay at home during the pandemic. Many continued to work from home at greater rates than before, and this spurred a lot of home improvement projects. And I think we also have a chart of the revenues of both of these companies. You can see that much of the big revenue increases that they saw was a short-term phenomena. And that chart reveals just how substantial and unusual that was. What you're looking at there is the revenue growth of Lowe's and Home Depot adjusted for nominal GDP growth. So let's talk a little bit also about price action. So despite the unremarkable results that Home Depot reported after initially falling about 2% from Friday's close, and I'm not talking about this last Friday, I'm talking about the Friday before, to Tuesday's open. So that's right after Home Depot reported. The stock rebounded after that and ended up closing the week with a weekly gain of about 2.7%. And Lowe's, unsurprisingly, sort of followed suit, and that rose 2.5%. both of those names outperformed the S&P week over week. And to me, that suggests that investors may appear to be looking past the current operating results. And what are those results? Well, consensus projections for Lowe's are pretty unambitious at the moment. Unsurprising given that the company's own guidance of $86 billion in revenues for the year represents an 11% year-over-year decline. And that, by the way, is significantly greater than the annual revenue decline that Home Depot reported over the same period. You'll remember that when I was talking about that, their decline was about 3% year over year. And this is interesting because we would expect the revenues of Home Depot and Lowe's to be pretty closely correlated, and we can sort of see that. I also have a scatter plot, and that scatter plot, what that's showing is that for the change in Home Depot, what was the change that we saw in Lowe's? And we can see that there is definitely a correlation there, but the spread can be fairly wide from one quarter to another. And the reason I think for this, and that is there's a couple different things. Home Depot has significantly higher retail sales per square foot than Lowe's does. And this is driven largely by the fact that Home Depot focuses a lot more on professional customers like contractors. In fact, I had a conversation a few years ago with their management, and they indicated that about 40% actually comes from professional contractors. So it'll be curious to see if that gap is going to widen, stabilize, or narrow, because Lowe's management has indicated that they are specifically interested in trying to increase their penetration into the professional segment. In any case, in the meantime, that has meant that Lowe's is traded at a pretty significant discount to Home Depot, and I think we also have some charts here that reflect those differences. Okay, so having set the stage by looking at fundamentals and how the larger peer did going into earnings and how Lowe's has responded in sympathy, and this is really, I think, one of the things that's going to matter when you're thinking about trying to trade options, hedge, whether you're going to use them, whether you're going to go long options or short them, is to understand how a stock is likely to behave on earnings. Is it risky to buy or sell the stock? If it is, do options offer an opportunity to reduce that risk, and are they priced reasonably? So to understand that, let's take a look at how volatile Lowe's has been historically in and around earnings. So if we take a look at this chart, what we're looking at here is 11 years of Lowe's price. What these bars are indicating, so the bars that are up, that is when the company reported positive earnings and the stock popped thereafter. Those declines obviously are the opposite. And just to be clear, so those columns that I'm looking at are from 1 day prior to earnings to 3 days after. And one of the reasons I sort of use that as my preferred measure is because I like to essentially allow the price action to digest the earnings results. So and actually we saw this in Home Depot. I think it was pretty clear. So they reported the stock initially sold off, and then it ended up gaining some momentum through the rest of the week. So one of the things we can see by looking at this chart is that more often than not, the stock has been higher. Moves of more than 5% or so to the downside are in fact quite rare. But we do have a couple big ones, and you can see them there. Actually, the most recent and the biggest decline actually took place in 2020. So that was sort of the pandemic plunge, and I think we might want to discount that just a little bit. It's probably not that likely that we're going to get another decline of similar magnitude. But what is interesting is that when we take all of this information put together and then layer that on top of the existing options prices, what we find is that, just in this case, I'm just taking a look at the weekly options prices, that those prices are in fact extremely reasonable. So this table, and I apologize, and in the future we're going to try to make this a little bit more legible because I've got a lot of information on here. So what we're looking at, just going from left to right, are different strikes. All of these are puts that expire at the end of this week. And what we can do is we can actually calculate based on historical volatility, in this case, just the 4-day move around earnings that we've seen, how much are these options worth in theory? And to understand that, just bear something in mind. It doesn't mean that they are going to be profitable. So if I say that an option has 25 basis points of positive expected value, that doesn't mean that if you buy it, you expect to make 25 basis points of the current stock price. What I'm saying is that out of 44 reported earnings, if you had bought a put of that strike and moneyness every single time going into earnings for the price that we can currently see in the market, you would have, after all was said and done, expected to come out ahead. And you can see that as you move away from the at-the-money strikes to the further and further out of the money strikes, and those are the ones on the left. So if you're looking at the screen, all the way to the right, that's essentially the at-the-money put, and then you can sort of migrate left, and you're getting further and further out of the money. What you can see is that the most out-of-the-money options, those actually did not end up being profitable, and that makes sense because, as we saw in that prior chart, moves of that magnitude happened very rarely or not at all. And of course, if options prices are reasonable for puts, then similarly, they are so for calls. And we can see that here too. So the at-the-money call has the highest average expected return and so on. Now, the important exercise here is that whenever you're going into a catalyst, you kind of want to get a sense of how volatile has this stock typically been on earnings. Because I think a lot of times people will take a look at options prices, and they will track something like the 30-day realized volatility. And they will say, okay, well, the price of options going into this event are substantially higher than that, therefore they're overpriced, and I'm not going to buy them to hedge. In fact, actually, they should be significantly more expensive. And what we find is that oftentimes what you get is very fairly priced options actually going into events. That's when stocks are going to exhibit the highest degree of volatility. I read one paper that indicated, for example, that as much as 40% of the moves that a stock might have within a given year could be attributed, in fact, to their earnings events and results. So, put very simply, with respect to lows at least, the options are very reasonably priced. Now, I went through this whole exercise looking at lows because on Wednesday, we're going to be taking a look at least two companies, including Target, which reports on March 5th. And we're going to start using some of this sort of same approach and technique to establish whether or not options are fairly priced there. In this particular instance, I admit Lowe's isn't super helpful. Number one, because Home Depot already announced. I'm guessing that some of that information has already been embedded into Lowe's. But the more important reason is that it's not going to be possible to trade weekly options on Lowe's before they report, because they're going to be reporting tomorrow morning before the open. Okay, so with that in mind, what I would like to do is potentially try to take a couple questions here. And let me just see here, because actually I think the way they're ordered, bear with me, this being my first time. Let's see here. So most of the first comments were that you guys weren't getting any audio. He may be whispering. I'm just going to throw that up there. He may be whispering. Dave Jury, well, thanks for watching, and if you're still here, thanks for sticking around while I got that situation sorted out. Okay. So there's a question here. I'm just going to throw this up here from Bob Delaney. A few weeks ago, Tony suggested a vertical call spread on Bristol Myers Squibb. I didn't execute that trade, and if memory serves me correctly, it was unprofitable. It might be worth a second look. Okay. So a couple things about that. First of all, I'm not familiar with that trade. So obviously, I work with OptionPlay, but I don't do the same kinds of stuff that Tony is doing. Actually, I'm managing a separate pool of assets at the moment, so I'm not actually paying much attention to those types of things. I will, however, be sure to take a look at Bristol Myers in advance of the Wednesday show, and I'll try to find out what that trade was, unless you want to post in the chat, and then we can figure what that one was together. There was a more interesting question here, because it is actually closely related to something that I actually do have on at the moment. So, Joseph Carnan asked, how do you think of a March 15th 4,900 put on SPX? All right. So, this is an excellent question, because as it happens, there's a couple things I would say about this. First of all, I have positions in SPX. In fact, I just rolled. So before the close, I rolled a position in the SPX March monthly 4750 puts out to the April 4800s. And that's the month ending April 4800s. And by the way, if you're wondering, well, why am I trading the monthlies in SPX options rather than the regular way? There's a lot of economic announcements that typically come out at the end of the month. And in fact, we're going to be getting some this week, which I think are really quite important. The Fed's preferred measure of inflation is the PCE deflator. We're going to be getting that later this week. That's one of their critical inputs when they're trying to determine policy. If we think that Fed policy matters for equity investors, and it does for anybody who's paying attention out there, I like to capture that. So that's just one of the reasons why I happen to look to the monthlies. So do I trade SPX options? Yes, I do. How do I feel about their prices? I think they're very, very reasonable. So here's some things to think about when we're trying to contemplate the value of SPX options. And by the way, when I speak of SPX options, this also applies to, for example, the value of SPY options as well, because they're very closely related. SPY options, XSP options, which are the SPX mini options. I don't trade those myself because I'd probably rather trade SPY than the XSPs. That is because XSP tends to have a wide spread. And actually, what we might do is we can just quickly take a quick peek over here. I'm going to use SPY as an example. I'm just going to pull up the OptionPlay application over here. We can take a look at these. But the observation I would make about index and ETF prices is that they are very cheap when you compare them to the price of single stock options. So when you think about it, the price of index options or ETF options has to be related to the volatility, to the price of options on all of the individual constituent stocks. It just makes intuitive sense, right? So if the biggest companies in the S&P, whether it's Microsoft, Apple, NVIDIA, and I'm just mentioning these biggest ones because they have the biggest impact on the index itself, as those stocks become more volatile, we would expect, all else equal, that the index too would become more volatile. Obviously, the amount that they track together is going to matter a lot. If all of those stocks track together and they all become more volatile, then we would expect the index to become more volatile. And essentially, once you start adding up the volatility of all of those constituent stocks relative to the index, what we are seeing right now is that the index is relatively cheap. So I like, at the moment, being long things like SPY put options or SPX put options against a long portfolio. If you are, for example, buying stocks and selling covered calls against them and trying to collect some premium, right now I think it sets up favorably to hedge that portfolio with SPX options. And why don't we just pick one out here, because I'm going to do something that looks, I think, fairly similar to the SPX option. So you were talking about the regular way 4800s. And if we're looking at SPY, that's going to correspond in round numbers, right? So we're just going to use this as just a general guideline to the 480s. And so these options are not going to have a high probability of profit. In fact, the probability of profit is relatively low. Why is that? Because the market generally rises over any 30-day period. And these actually have less than 30 days to go to expiration because we're getting close to the end of the month here. 60% of the time, the market's going to be higher. Stocks generally rise and the index generally rises. So when you're making a bearish bet, you don't expect it to be profitable in the same way that you don't expect your car insurance to pay off, hopefully. So here too, we're hoping that these things stay out of the money. But what is interesting is that their relative cost for the insurance they provide, I think, is very good. And if you are using a margin account, for example, and you are hedging your portfolio with something like this, I think you're going to get a lot of bang for the buck, because here's something that important that happens. When the market declines, correlation tends to rise. So you might have stocks that are doing well on earnings. You know, Home Depot didn't report great results, but the stock did well. NVIDIA gave stellar results. That stock did well. There are some other stocks, though, big stocks in the S&P that have not done well. Immediately coming to mind are companies like Archer Daniels Midland. They pre-announced, I think it was January 23rd, stock got hard hit. They had, higher, I think, EPS guidance. Now they're guiding to $6.90. So if you have a portfolio of these stocks and you hedge it with an index proxy like this, I think that's a good idea. I think they're very, very reasonable. Okay, so here's a question, and I apologize if I'm sort of hopping around, not in order, but there's a couple pages of questions. So, okay. I was told options don't get assigned with more than 21 days to expiration, even if they're in the money. However, I was assigned. Okay. So let's talk about that. So in terms of early exercise and assignment, there are two principal reasons, three, I guess, why options would be exercised early, where it makes good sense to do that. What are those? One, you exercise calls early, generally speaking, for one of two reasons. If the stock is about to pay a dividend and the net present value of that dividend exceeds the extrinsic value of that strike, which you can establish by taking a look at the corresponding put, then that call is very likely an exercise. So imagine the following. You have a $50 stock. You have a 45 strike call. You are short that call. And you're wondering whether you're going to be assigned. The stock is about to pay a dividend, and we're going to be a little bit absurd about the amount of the dividend. Let's just say that the dividend is $1. That would be quite high, because that would be an 8% annualized dividend, since dividends are typically paid quarterly. But let's just, for the purpose of the example, let's assume it was. If the 45 strike put of the same expiration has a value that is significantly below that dollar dividend, that call is likely optimally an early exercise. So if you're short that call and you get assigned, X dividend was very probably the reason for that. What's another reason? You can get into situations where stocks are really hard to borrow. And if they're very hard to borrow, then it can be optimal at times to exercise calls so that you can take delivery of the stock. Although I will make a very quick point about that. There was a time many, many years ago where I exercised 500 calls in an impossible to borrow stock, and was stunned when at settlement I only received 1,700 shares instead of the 50,000 I was supposed to get. And it was the first time that had ever happened to me. It's the only time that it has happened to me in 25 years. But it is important, and I found out that there's a force majeure in the OCC guidelines about this. But it turns out that there are really extraordinary cases when you exercise a call option and you don't take delivery. The way stock settlement works, though, it didn't really matter, because there was a buy-in, and basically it's a waterfall. So if somebody tries to buy you in, somebody tried to buy me in because I was supposed to deliver the stock. Because I was owed the stock by the street, that in turn forced a buy-in on whoever was short the calls. Turned out, interestingly enough, it was the same person, a trader at Goldman Sachs. But anyway, that's one of the reasons. With puts, why are puts exercised early? So any of you who've been trading options for any length of time over the course of the last 10 years, you've probably not seen early put assignments. And now suddenly you are. Why is that? It's a cost of carry issue. So if you can imagine that, I'm going to use another sort of absurd example, but again, $50 stock, now we're going to look at the 100 strike put. When interest rates are 0, I have no real carry costs in carrying my stock position. I'm not sacrificing interest paid on a cash balance. If I've got a margin position on the stock, that rate is probably not high. And then, of course, I've got that premium. So in this case, $50 worth of premium. That's also an outlay, but not a big deal. I could always offset the premium in other ways. I could sell boxes or something like that. But now, interest rates are not zero. Now interest rates are 5%. So if I'm paying 5% effectively by owning stock instead of having a cash balance, if I'm paying 5% on all of that extrinsic premium for the put, well, in that case, that put is an early exercise because the interest is actually worth more than the extrinsic value of that strike. That 100 strike call isn't probably is worthless. But meanwhile, I'm losing 5% annualized just in carry cost. So that's one of the reasons for that. Okay, so let's see. What else have we got here? And I apologize again. I'm going to just start picking some of these at random. Do you ever use short-dated options to play for an earnings move? The short version of that is yes. All the time, actually, because we do a lot of event trading. So in the fund that I managed through the end of last year, I'm not doing that anymore, which is one of the reasons I'm actually able to do something like this. We did about 600 event-related trades in that fund last year. So just a very quick observation, and this is sort of related to something I was saying before, which is that there's an assessment that people should be looking for expensive options to sell. Options prices look like they're elevated going into earnings, therefore I should sell them. That is generally not the case. What I will usually do is try to get some convexity around spot. What I mean by that is I try to get some optionality around spot, and then I will usually try to sell wing options close to the implied move up and down. So, or just outside of it. So $50 stock, 10% implied move, 5% higher or lower. In fact, we actually try to look at the implied move up versus the implied move down. But in simple sense, let's just imagine that it had as big a move as that. I would probably try to own something at the 50 strike, the calls obviously if I was betting to the upside, and then maybe short the 55s against it. Sometimes on a ratio, by the way, because I'm often trying to put those types of trades on. If I use something called a call spread risk reversal, where I buy an upside call and I sell a downside put to help finance it, I'm trying to get that premium fairly close to even, and I'm basically trying to look at how big those moves are. Okay. How do you factor seasonality into your trading? The truth is not that much. I don't really think about seasonality necessarily in terms of how the stocks or the market behaves. There are a couple exceptions to this, though. So generally speaking, I have found that volatility tends to tick up significantly after Labor Day, September, October. Things quiet July and August. So there have been instances where I have been sure to be long Sep, Oct, November volatility even into the summer. So I'm long those options and carry them through Labor Day because I just don't expect them to decay that much. So options lose value for a couple of reasons. One of the reasons, of course, is that time passes. That's an important thing to think about. The other thing is that near-dated options tend to have lower options premia if there's no identifiable catalyst than longer ones do, the way options traders tend to think about it. And I don't mean to get too wonky about it, but implied volatility space. So basically what that means is that longer dated options are decaying through time, and also they're sort of sliding down this volatility curve, this term structure. And I'm sure you've seen term structures for rates, you've seen term structures for all kinds of things. That is not the case generally from mid-summer through early fall, my experience. Another time that I concern myself with the seasons is retail names on the back end of the holiday shopping season. I definitely factor it in there because that tends to be very important for the retailers. Okay. So let's see what else we've got here. I think that is kind of interesting, and not that all of your questions aren't. Here, I was shocked that you traded 500 contracts even more impressed there were 600 event-related trades. Okay, so just to be clear, my background is as an institutional trader. So 500 lot contract trade for us was not big. It probably would be considered relatively small, actually. Actually, the largest trade I ever did was 250,000 puts in UNG a number of years ago. It was May of 2010. I think that was the largest contract-related option trade that had happened so far that year. It took us 4 days to put the whole thing up. But by the way, just so you know, we syndicated a lot of these trades. So that 500 lot was me, but on the 250,000 lot, I didn't take down all of one side of that, only a very small portion. So, we were a bank, we had a balance sheet, but when we syndicate it, we team up with other dealers or other institutional traders, some hedge funds and things like that, and you break it up. So you have one big initiating side, and then typically you try to spread the risk around as much as you can. So institutional trading, institutions just move a lot of money, so it's not surprising that sometimes the contract quantities are going to be a little bit bigger, but that's not a reflection that it isn't just as important to trade a 5 lot in your personal account as a 5,000 lot in an institutional one. Actually, if you're trading in smaller size, you have an advantage because there's no liquidity considerations. You're not plowing bids and offers. People aren't shooting against you as much. You don't have to worry about toxic flow as much. So I think that's something important to think about. Okay. Is it okay to use stops on option spreads using the option prices as the trigger? I placed a stop on a 3-leg butterfly that I purchased. However, it got triggered prematurely, could not figure why. A stop on a butterfly. Okay. Okay, so let me put it to you this way. I would probably not leave stops out on multi-leg options trades like that. Just a couple quick things about it. I'm guessing you probably weren't happy with the fill that you got. So when you put in a multi-leg option order and you just park it out there, that order is sitting on something called a complex order book. So what's going on is each leg is not being reflected in the marketplace as if you had entered them in individually. So imagine 45, 50, 55, call fly. If I was trying to buy that fly, so I'm bidding for the 45 calls, selling 250s and buying the 55s. If I was doing that leg by leg, I could put an order out there and it would sit on the book, and the same for the other legs. Not true in the complex order book, and fewer market makers are actually looking at the complex order book, so chances are when you get a fill on a resting order in the complex order book, chances are that fill is not that great. I'm not going to say that it doesn't make sense to execute options orders in spreads, because if you're, depending on how much capital you're using, there can be a really important risk consideration. Example for that call fly, if I'm trying to buy one, sell two, buy one, and I accidentally just sell the two and haven't bought the two wing options, I could be taking substantial risk, right? So the fly doesn't have a lot of delta risk. It doesn't have a lot of exposure to the underlying. My risk is defined as essentially the amount that I spend on that butterfly spread. On the other hand, if I sell two calls naked, well, now my risk is unlimited. So that's a very big difference. But I would say that I don't typically like to use stops. I'd much, much rather just monitor the underlying and monitor my options trade and just make that determination. I think one of the reasons people use stops is it's a discipline thing, right? So when you're looking at it, it's a whole lot easier to say, I don't think I want to do this. Even if you have a rule that say you lose 40% of your premium, you're just going to blow it out. Just something to think about. Okay. I see another one that says, any appetite for an SPX put? I think we talked about that. We own SPX puts. I actually, just to be clear, so we're long April month-end 4,800 strike puts. I also actually have some March month-end upside calls. Just to be clear, what's going on there is that is a hedge for a broader portfolio of stocks where, in general, because I think single stock options premiums are elevated relative to index, I'm actually short some premium in single names to be long that stuff. So, so that 250,000 contract should have been a multi-million position for a pretty big gain, as UNG is a constant downtrend. Yeah. UNG is in a constant downtrend. That is because of the roll cost. So when you have ETFs that are basically funds where they trade futures, and the futures always are in sort of an upward term structure, what happens is they buy the front month gas futures. Now, by the way, UNG, which is the U.S. Natural Gas Fund, they don't just trade listed futures contracts anymore. They did at the time, at 2010, when I was trading those puts. All they did was trade the NYMEX Henry Hub natural gas futures contract, which is a 10,000 multiplier. And it turns out had, I think, a 300,000 contract limit. That ended up being very important. So it's true that a lot of those types of ETFs will generally go down. And that's because of that roll cost. Now, you're saying that it should have been a multi-million position for a pretty big gain. It was a pretty big gain. It was not a pretty big gain for me, though. The reason was that I ended up selling those. So UNG was 1565. I think it was mid-May of 2010. And we ended up selling 250,000 of those October 14 puts for $3.45. By the way, when you do a trade that size, you remember it decades later, as I do that one. And UNG, and actually I was doing a vol trade. So my idea was I was going to sell the October 14 puts, and it was just not just me. There was a lot of other traders who did it. We were going to sell that at a very juicy vol, as you can guess, $3.45 for a 14 strike put when the underlying is trading 1565 is pretty juicy. And then I was going to short UNG against it. The problem was that UNG went hard to borrow on settlement. So the trade actually didn't turn out to be such a huge winner, but that's probably a story for another time. I want to write a poor man's covered call on Google. My only concern is I'll get called away and I won't meet the margin requirement. Will my broker give me time to buy back the stock? A poor man's covered call, for people who aren't familiar with that. So a poor man's covered call is when you buy perhaps a longer dated call and then sell shorter dated ones against it. So that is covered. You don't really, it's not a situation where you're suddenly going to be, you could be assigned on the short call and then you'll be short stock, but you're still going to be long the longer dated call. So that short stock position is also covered. So assuming that you have, unless your broker is out to lunch, I don't think that's going to be a problem. Usually, I'm imagining you probably have a CPM account, customer portfolio margin account, which is a lot like a JBO account for a broker-dealer, and you're going to get margin requirements that aren't that strenuous, but you should be able to do that trade just fine. Just make sure that if you buy a long-dated call in Alphabet, Google, GOOGL, by the way, is the one that he's looking at. It's interesting. I never understood why people would buy the non-voting shares until I ran a registered investment company fund, and then you have to do all the proxy votes. There's actually real advantages sometimes to just trading Goog, which is the non-voting version, just as an aside, if you don't care about the proxies and stuff like that. The thing I would just make sure, don't exercise your long call because you get assigned on the short one. You are protected because you got that long dated call. If you want to, you can cover the stock. You can cover the stock and sell your long call. You can cover the stock and initiate a new short call at a higher strike, or you can go up. You can go up and out, whatever. But just don't exercise a long dated call. It's not optimal to do that in almost any circumstance. You need really short dated calls in the money, either impossible to borrow stocks or right before the ex-dividend date. And even then, don't bother. If you have an ex-dividend date coming up and you're along the call, instead of trying to exercise the thing early and trying to make sure that you inform your broker correctly, just sell it and move on. Okay. What else we got here that's interesting? Oh, yeah. So Joe came back to us about that SPX, but just insurance for a portfolio. Yes, I think that's advisable. Same thing I was talking about the SPY options. I think they're very reasonably priced relative to single stock options right now. Certainly, if you're trying to hedge, you're way better off a portfolio. You're way better off doing it with index options than single stock options right now, just on a relative price basis. So yeah, that absolutely makes good sense. Let's see what else we got here. I was told, okay, that was, yeah, so this is basically the same question about getting assigned early. So that I think is important. Let's see what else we got here. All right. Somebody is saying that Zoom is up 760. That could very well be. Okay. So, I don't want to keep everybody here for too long. On Wednesday, we're going to be talking about target earnings. We're going to use some of the same concepts that we just talked about. We're going to look ahead to some other things. We've got PCE later in the week. Quick point, we do have an affiliate link in the description below for OptionPlay. All of the comments that were left here right now, if you come back and watch this later, unfortunately, just the way it happens, the replay, you're not going to end up seeing those. Be sure to like, subscribe, and I really appreciate you guys tuning in to watch all of this. I think I'm going to have fun doing it, even though I'm very clumsy at it right now. I apologize for that, but hopefully I'll get more used to these live streams, and hopefully you guys will bear with me and see me the next time on Wednesday, 4:15 Eastern Time. See you then.